Hey Central Virginia, are you curious to know what's actually going on with our local housing market? We'll cover that today on your June 2023 Housing Market Update. What is going on, party people? Thank you for tuning in. In this video, we are going to cover what is actually happening in our local Central Virginia housing market. Thank you guys for tuning in. Let's get right to it. So, the first topic of the day is we are going to cover mortgage rates, and the question everybody's been asking, why are they so dang high? First and foremost, I would submit to you that we are not in a high interest rate environment. We might be in a higher interest rate environment than we were in during the unicorn years of the pandemic. But 3% interest rates are not the norm, and 7% in a historical context is kind of in the middle. But let's cover why they're a little bit higher than maybe they historically would be, given the 10-year Treasury yield. So historically speaking, there's been a correlation, correlative, I didn't do well in high school. There's been a good relationship between the 10-year Treasury yield and the 30-year mortgage rate. Historically, that relationship's been about 1.27% difference between the 10-year Treasury yield and the 30-year mortgage rate. It's varied throughout the years, but historically speaking, the kind of average difference between the two has been 1.72%. So currently right now, based on the 10-year Treasury yield, which is about 3.65%, we are seeing approximately a 3% delta between the 10-year Treasury yield and what the 30-year mortgage rate is currently at, if I can say it. So we're seeing almost double the historical norm difference between the 10-year Treasury yield and mortgage rates. So this is due to a number of factors: inflation, economic uncertainty in the capital markets, and a lot of other factors that is a different topic for a different video. But the thing to understand, this is a very rare occurrence in which we see this much of a difference between that 10-year Treasury yield and the 30-year mortgage rates. In fact, looking back to 1970, this has only happened about 3 other times where we've seen this much of a delta between those two numbers. This fact leads many forecasters to think that mortgage rates will eventually fall later this year if that delta starts to come down. And if we look at it, if that difference between the 10-year Treasury yield and mortgage rates dropped to even 2.25% and the 10-year Treasury yield stayed the same, we would see mortgage rates hovering at about 6%, which of course would send the market into another free fall in a good way where it would just heat up tremendously. All right, so now let's get into the meat of the episode, the star of the show, the Richmond housing market. All right, so fun fact, based on a Fannie Mae survey that was taken at the end of 2022, 37% of Americans at the end of 2022 thought that we would see home price depreciation in 2023, and if you are somebody that is watching this that fell into that camp, I'm happy to tell you that you were wrong. Not because you were wrong, but because that means home prices have continued to appreciate. So despite what you might be seeing on the news, despite what you might be seeing on social media, despite the factual data that you may be seeing about other real estate markets throughout the country, and of course, despite what your drunk Uncle Larry might be telling you at your next family get-together, the Richmond housing market is still absolutely in fuego. All right, so let's look at the actual numbers. These are statistics pulled straight from the Central Virginia MLS, hot off the press. So if you look at the median sales price, that has continued to climb throughout all the way from January and continues to climb throughout the month of June. The average days on market is currently 6 days. So just put that in context and repeat that. The average home seller in Central Virginia is selling their home in 6 days, and that is down compared to the dark days of December and this past January, in which we were all the way up to 8 days on the market, and folks were suffering, and there was gnashing of teeth. In the month of May, on average, sellers got 102.2% of their asking price. Yes, on average, home sellers in May got 2.2% over their asking price. And in Metro Richmond, we are currently at 0.6 month supply of inventory, which is very close to the 0.4 month supply of inventory that we saw at the height of the pandemic unicorn years. So essentially, we are back to the supply-demand ratios that we were at the height, the craziest part of the pandemic housing market. So as you can see, the Metro Richmond market is absolutely on fire. Now, one thing that we are keeping our eye on as we record this on June the 13th is we historically have seen pre-pandemic where the Richmond housing market, much like many housing markets, slows down a little bit during the summer. As the kids are now out of school, folks are on vacation, kind of focusing their attention elsewhere other than the housing market. And we typically see a little bit of a drop in sales that kind of gradually declines throughout the year. We did not see the summer slowdown during the pandemic years, which were unicorn anomaly years throughout the housing market. We're seeing early evidence that we're going to be returning to the normal seasonal pattern that we've seen, historically up until 2019 in Metro Richmond. So that's something we're going to keep a close eye on, and we'll keep you guys informed. All right, so what does this all mean for you? If you are somebody that is selling a home, realize that interest rates have not killed the party. So despite what you might be hearing, despite conventional wisdom, once again, despite what Uncle Larry is telling you that interest rates have completely killed the housing market, that is certainly not the case in Metro Richmond. Now, I will say that has slowed down the overall number of sales, and that has had a greater impact on the housing market in other markets. Florida, Texas, the West Coast. They are seeing a more drastic slowdown than we are. We have not seen a slowdown. Now, like I said, we've seen less sales, but the ratio between supply and demand has remained relatively the same, which is all that matters to you if you're somebody that's looking at selling your property. Secondly, overpricing can still hurt you. So if you are somebody that thinks just because it's a hot market that you can throw whatever price that you want on your home, realize there are still homes that are sitting that are being overpriced, and it is negatively impacting those home sellers, and they are not doing as well as they could have given current market conditions. So we still recommend putting a fair market value price on your home and not overpricing you. We're not seeing where buyers are just willing to pay anything that you ask for your property. And then last but not least, realize that selling as is an option. So if you're somebody that has a property with deferred maintenance, or you just prefer not to have to deal with the normal repairs of a home sale, realize that you can sell as is. You're typically going to sell for less money, but it is an option on the table for you. For my buyers, hate to break it to you, but the Hunger Games continue. It is very competitive out there. So realize if you're stepping into the market to buy a home, it is very much still a competitive market. The odds are still very much on the seller side, and it just is what it is. Secondly, mortgage rates are not the only factor. So we have a lot of buyers that are taking themselves out of the home buying process or sitting on the sidelines complaining about interest rates. And I get it, interest rates are higher than what they were before. But think through this, interest rates can do one of three things. They can either go up, they can go down, or they can stay the same. If interest rates go up and you buy a home now, you're going to be thankful you did, because it's going to be cheaper now than it would be in the future. If interest rates stay the same, then nothing really changes except the fact that home prices may continue to go up. So even if the interest rates stay the same, you're going to be glad that you bought a home now as opposed to 12 months down the road when homes have appreciated another 5 to 7% or wherever they may go in the future. And then lastly, if interest rates go down, you can always refinance at some point in the future if and when interest rates come down, which I think collectively most mortgage forecasters agree that interest rates are going to come down at some point in the next year or two. So that's all I got for you guys. Thank you guys for tuning in. If you have any questions, comments that I didn't cover in this market update, be sure to leave a comment, shoot me a direct message. Thank you guys for tuning in. Look forward to seeing you on the next video.